Hi, and welcome to our weekly Macro Hive Week Ahead video. I'm Henry Occleston, covering for Andrew, and I'm joined here by our excellent US strategist and chief Fed watcher, Dominique Dwor-Frecaut.
Hello, Henry. I love your backdrop, almost inspiring as Andrew's.
Yeah, no, I was inspired by him, but I'm joining you on the West Coast this week rather than in windy, rainy Yorkshire as normal. So it's been obviously a very busy week in data, and also just to sort of do our usual plugs, a very busy week for you. So you've been getting set up on Twitter, where you can follow Dominique at First Kick Tires, which is
Right.
I like.
I like to not take anything for granted, make sure I understand everything. So that's where the handle comes from.
No, I thought it was very apt. It was much better than mine, which is very boring. But and you were featured on Primetime on Bloomberg, which is very exciting.
Yes, that was a fun interview. I got to give my opinions on the Fed, which I kind of like, as you know.
No, absolutely, and you got some good ones. Well, clearly they're starting to really feed through properly now, and that's going to be a good part of our conversation today. So you can be as controversial as you'd like on that. So I mean, just to sort of fun.
I was joking.
All right. Yeah, so just to sort of cover off the previous week, clearly one of the big releases was CPI, and while it was sort of largely in line with market expectation to a large degree, we got some pretty strong reactions anyway. So obviously had S&P selling off, had US Treasuries off, and then just after it, we got two non-voters, so Bullard and Mester, both sounding like they were talking up why they would expect potentially hiking to go even further, and sort of playing up the hawkish tone. So I suppose the first question is, do you think there was anything in the detail for the CPI that really changed things for them, or would have sort of justified such a shift?
So there was, certainly we saw a recovery in the median price CPI, which until Tuesday looked like it was trending down. And the median price CPI, when there is a lot of volatility in prices, tends to be a better indicator of trend than core. I think the other thing that was going on is that, the surveys basically reflect the median view of market participant. By definition, this is how Bloomberg presents it. While the people who put money on the table tend not to be the median opinionator in the market. They tend to have more extreme views. So it could be that, the people who had put on the position actually were expecting the data to be milder than it was, or expecting some downward surprise. And the details, on top of that, the details were not great. We're starting to see stabilization of goods price from previously deflation, something that Chair Powell had hinted at in his interview with David Rubinstein about 10 days ago. That's not good, because goods price deflation was making up for strong inflation in services. For me, the CPI was basically along what I was expecting. The economy has a lot of momentum, labor market is very tight, and so on and so forth. But I guess...
Was there any sort of change in the weightings at all? Because obviously it was just sort of getting into January readings. Did that have any kind of effect? Because I know it did in the UK, but...
Sure, the weighting changed things. They made the data look worse for last year. But the risk with all this is to get very caught up in the little details and overly analytical and lose sight of the big picture. And to me, the big picture is really the median price CPI recovering and showing that basically underlying inflation trends are not weakening.
Yeah, that makes sense in fairness. And from a market perspective, I suppose we've had a pretty decent rally in terms of risk into the start of the year. It was kind of starting to fade, and I guess, I mean, could this now be the sort of capitulation in terms of the hopes that there was Fed getting towards being done? Do you think the sort of bringing back to the table of 50 basis points is sort of going to gain traction ahead, I suppose? Or
yeah, I mean, there is no question. I mean, those comments from Bullard and Mester were quite extraordinary. So both are regional Federal Reserve Bank presidents, and they are not voting since there is a rotation, the 12 presidents as voters. And they made their point. So one made the point in a speech where you couldn't be more explicit, and the other one made the point in a Q&A just before the minutes get published next week. And this could point at some frustration with Fed decision-making process, a sense that they are not being heard or their views are not being adequately reflected in the minutes, and this could be why they've reached out to the public. If so, it suggests that the hawkish feeling within the FOMC could be stronger than suggested by previous Fed communications. But in terms of the big picture here, if the data continues to be as strong and as the NFP and the CPI and continues to show that inflation trends have not changed, there is a good chance that the Fed will go for 50 in March. Now we still have one round of CPI and of NFP before that meeting. But I think it's definitely, the option is definitely on the table.
Oh, interesting. And in terms of the, you sort of spoke about the sort of possibility that the composition was a little bit more hawkish than has potentially been sort of indicated. Obviously, we've now, or in the week, we had news of Brainard's departure. So she's been a sort of main sort of dovish voice on the board. How does that play into this? And are there any sort of timeframes set out for that?
So I think definitely it tilts the balance of power in favor of the hawks, just at the time when the data is also supporting the hawks. We heard this week that the administration is considering appointing Occleston Goldsby, who used to be an economic advisor to Obama, and has just been appointed as chair of the Chicago Fed, president of the Chicago Fed. He's apparently a contender for Brainard's job. I think it shows, this is quite, if the rumor turns out to be correct, it will be quite a fast turnaround for the administration and could reflect that the administration is concerned over the Fed turning more hawkish, and therefore wants to find a replacement for Brainard that is as dovish as she is. Which I'm not sure this is very logical. We are being very logical here, in the sense that the Fed not reacting to inflation, high inflation prints, can only mean that inflation gets stronger and maybe just on time for the 2024 election. So I'm not sure what's going on there. But anyway, in terms of Fed decision-making, certainly Brainard not being at the March meeting, I think makes a difference.
Yeah. And is there going to be any, I mean, in terms of the process of approving replacements, or be it Goldsman or whoever, is there any chance of pushback? Or
I don't think so, because the Democrats have a majority in the Senate. Also, Occleston Goldsby is a dove, but not a controversial one. And you know that Senator Fetterman just checked himself in a clinic to be treated depression. So the Democrats have gone from 51 senators to 50,
So tight.
but they still have the vice president to cast the deciding vote. So no, I don't think confirmation would be an issue. I think it's just going to take time, and it's not clear if the administration has really decided to go for Goldsby. It's not clear it can be done on time for the March meeting.
I see. So, and you're retaining your, I mean, you've put out a sort of refresher piece this week on the 8%, the now very well covered by the media 8%. Could you talk us just, I mean, maybe just a little bit of insight into, is it still the Myth versus the Taylor rule that's sort of driving that, or is there anything sort of changed in the, since you called that almost a year ago, or maybe less than that, but
so
in terms of
basically,
the evidence, yeah.
Yeah, basically, yes, it's a myth. I mean, it's basically the Fed game plan remains weak. I mean, they had this expectations augmented Phillips curve that led them to declare inflation temporary, transitory. Inflation was not transitory, so they given up on that model, but they don't really have a model to replace it. They are, as I said, data dependent, which means they will react to inflation, which means they are going to be behind the curve, remain behind the curve. So that was the first reason. The second reason was the Taylor rule, the gap relative to the Taylor rule, which is still wide. And if you look at what's going on with residential real estate prices or credit growth, I stick to my guns that monetary policy is still loose. And the third part of the call was inflation inertia, which I think is still there. You can see it because there is still a feedback loop between wages and prices. And I think you'll need a recession to break that feedback loop. And so, yeah, sign and persist.
Oh, fair enough. And out of interest, you sort of mentioned election, and you also, which obviously a couple of years away or next year. I mean, I remember someone saying around, wouldn't it be sort of almost favorable for them to get the recession out of the way early and get the growth back on track in terms of 2024? Do you think there's any sort of, is it sort of a, I suppose in your mind, a sort of done deal that they'll definitely go for a dove who's going to sort of potentially kick out that hiking process, or maybe delay that?
The administration so far has only appointed doves to the committee. So I could be wrong as always, but I'm not seeing changes in their mindset.
Okay, fair enough. And then you sort of mentioned housing costs, and this week we do get PCE, which is obviously, well, the Fed's preferred measure, but largely sort of moves in line with CPI. Do you see the sort of lower housing weight there making any change, or what's your expectation for PCE this week?
So what I'm looking for, because the consensus forecast seems reasonable, 40 basis points for core month on month, but what I'm looking for there is a recovery in median price PCE, similar to the one we've seen with the CPI. And as always, it's a breakdown between Powell's three components. We already know what housing PCE is going to be because it tracks the CPI very closely. But frankly, I'd be surprised if we saw signs of a marked slowdown in either goods or core services, excluding housing. So that's what I'll be focusing on. The other piece of data, which is super important, is personal income and consumption. And it's super important because, to me at least, because the household savings rate is now rock bottom, but recovering. And last year, the decline in the household savings rate was what kept the economy going, despite this absolutely unprecedented fiscal consolidation. But now the savings rate is bottoming out, but very gently. So I am looking for a continuation of that pattern savings rate, maybe around 3.5–4%. Because one risk to my very bullish view on growth, inflation, and the Fed is, of course, a very sharp increase in the savings rate. So I'll be watching that.
And in terms of the savings rate, so for my knowledge, a recovery there you'd see as being sort of a sign of less consumption, not so much sort of a rise in real incomes, but just sort of pulling away and building up your stocks, and therefore a more dovish sort of, all things equal, kind of outturn, I suppose.
Yeah, so definitely, the US economy is 70% consumption. So if the savings rate rises, for a given level of income, consumption will slow. Yep. And that could very well put us on the path for a soft landing. So that's not my base case scenario, but that's one of my key risk. And so I will be looking at it very closely.
No, absolutely. That'd be really interesting to watch. And I'm sure it'll certainly give the market something to think about. No, thank you so much. I'm just, as we tend to do, just give a quick highlighting of the main pieces we've sort of put out this week, and especially from you, have been some very, very interesting ones. So in Pro, in addition to our sort of usual tracker pieces, we put out some great reports, including Lael pulling together his top 5 takeaways from his recent trip to the US. Mustafa's Rates Weekly touched on whether it was time to add convexity to portfolios on the back of the very strong US data and the sort of short-end volatility. We also got pieces out on the dollar JPY and euro dollar, and why the sort of China story is going to play into that very, very well. And then we also got a piece, more of an interest piece, sort of from Sam on the sort of 25 ways AI chatbots are revolutionizing research, but hopefully not putting us out of our jobs. Then across on Prime and Pro, we've obviously got your piece, which I would highly recommend both our Prime and Pro clients checking out. We've had Richard Jones starting a new piece on sterling and how to sort of play the ranges with a bearish bias. And for those interested, I put out a piece on 3 geopolitical crises that I'm sort of watching through the rest of this year, as well as our updated periodic ECB and Bank of England monitors, where, just for information, I'm expecting the ECB to hike through 3.75% as a base case, and the Bank of England probably to pause from here, the sort of growing case for that. And then sort of finally, in the context of changes at the BOJ, I definitely encourage watchers to check out Bilal's podcast with Natsuoka-san on what lies ahead for Japanese inflation and the BOJ. And then finally, we've got the revamping of our crypto newsletter. So a lot to sort of to watch out for there from all our clients. But thank you very much for joining us, Dom. I know it's early where you are, but hope you have a great week, and we'll be, I'm sure, in very close touch with all the news.
Thank you, Henry.
For everyone else, hope you all have a great week, and hopefully Andrew will be back next week to sort of give you a far more fluid experience, I'm sure.
You were great.
Cheers. Thank you.